So today we're going to talk about my second video of Secrets of Successful Property Management Expense Edition. So this is a three-part video series, first on income, second on expenses, and third on debt, and of course on cash flow, which is the formula and the math that all successful professional investors follow. For those of you who weren't able to watch the first video on income, this is the financial waterfall that all investors look at and all lenders look at. First, they look at the property's income, and in video one, we talked about rent income, but also other income and the different kinds of sources. So if you haven't seen that video, be sure to check that out. Today, we're going to talk about expenses, and these are things that we do in our company to manage or negotiate and even reduce some of the operating expenses at the properties. That translates into the net operating income. And this, of course, is what the lender uses to see what they're going to lend. So many of you know that I wrote the book, The ABCs of Property Management, and we talk a lot about these things. But in this video, we're actually going to go into much more detail on how to manage both income and expenses and the debt to generate the most cash flow that we can for any property that you're looking to buy or maybe that you already own. So in video one, we talked a lot about income, specifically regular income, but also other income. And there are lots of ways to grow that and manage that to be very successful on any property that you're looking to buy or that you currently own. Today, we're going to talk about expenses. And as you know, there's lots of things that you can do on the expense column to both save on expenses and manage expenses better for the long term. But both of those are the result of the net operating income. And most of you know that this is what the bank uses to lend against. They're looking at the net operating income when they're deciding how much of a loan am I going to give this property and this partnership. So in video three, we're going to talk about debt and cash flow as it relates to all of the things we talked about in income and expense in this video, but also how you can maximize your cash flow to get the highest debt that you can so that you can maximize the leverage for both you and your investors. So there are 8 categories of expenses that I'm going to cover today. First being payroll, management fees, second, advertising and marketing, repairs and maintenance, utilities, insurance, property tax, and Capex or capital expenses. Now, each property is going to be very unique to this depending on the size, location, age, condition, etc. And I'm going to go through those next. The first category is payroll. So those of you who have small properties, you may not have payroll, but as you grow your portfolio and you get into larger and larger properties, you're going to find that payroll is going to be needed. Here are the deciding factors that we look at whenever we're deciding, does this property need small payroll, no payroll, or a large payroll? The first one, obvious, office hours. Not every property is open 7 days a week and maybe 12 to 14 hours a day. But if it is, it's going to require a larger staff. 2 is location. So there are some properties that we used to manage, let's say in New Mexico, in the middle of nowhere, that were really hard to get people to work there. And we're even having that case in some of the smaller cities. So location has a lot to do with what you're having to do from a payroll standpoint based on the amount of available employees in that particular area. So be careful when you're picking your property as you start to look at the employment base of that particular area. It could also work on the opposite if you're in an area that is a high demand for employees and you can't get any to work for you at all. The third thing is age and condition, and these are very different things, but I put them both on here. So obviously, if you buy something from the 1960s or the 1970s, it's going to require more maintenance and upkeep than something that's new. So the age is very important. However, you see many properties that are old, that are renovated, that are in great condition. But this is a category that you want to watch very closely because you can even buy brand new properties that are in poor condition and old properties that are in great condition. But either way, the amount of time is what we're talking about here. You need to pay attention to that. So the next one is size. And typically, if you have a property, let's say 50 to 100 units, then that's going to require anywhere from 1 to 3 people, depending on the size, condition, and location. If you have a property that has 50 units, for example, you're going to need in-house maintenance. You're going to need somebody there to be able to show units and those kinds of things. And you're going to have the property open for business for those people. The smaller the property, you're probably going to rely on the property manager, which we're going to talk about in a minute. But in most cases, on properties of any size, you're going to want to have a staff at the property to take care of the residents that are there and, of course, any future ones that you might want to consider. The next item is vacancy. So there are many properties that are incredibly located that almost had no vacancy. In fact, somebody moves out, you have somebody moving right back in. But that actually is a small percentage. Most of them have to fight for occupancy and fight for new tenants. So this can vary widely from property to property, and thus can the payroll associated with that. Obviously, if you have a property that's highly occupied all the time, your payroll costs and your maintenance costs are going to be significantly lower. So this is why location is very important on where you select your next acquisition. So AI or software is another category that we need to talk about. So many people are buying Airbnbs, for example, and the entire system is fully automated from soup to nuts, from the move-in to the rent collection to the maintenance, all the way through to the cleaning of the unit and the move-out. The entire industry is moving more and more toward an AI software, especially with the pandemic and everything that happened, where we're actually now showing units virtually. So you really want to have your units online on some kind of a website. You don't have to have a special one for your property, but I do recommend it if your size is large enough to be able to have something that you can drive people to at all times, and they can even rent online. The next category is the resident profile. So obviously, if you have a property that's next to, let's say, a university, you're going to have a lot more turnover than something that's maybe in a senior community. Because as the students come and go to the university, as an example, whether they renew or not renew or go back home for the summer, all those kinds of things are move-ins and move-outs. So resident profile is very important as you're taking a look at which property to buy. Thus, depending on those items, it determines the size of your payroll. So obviously a senior property that's going to have very little turnover each and every year is going to be much different than, let's say, a student community that might have 100% or close to 100% as the school year ends. The last item is financial performance. So I bought properties that are 50% vacant, for example, where it required a lot of payroll to turn the property around and get the thing stabilized. But once we got higher occupancy, then we were able to reduce the payroll. So your payroll can vary largely based on the financial performance of the property from month to month or year to year. So it doesn't always necessarily have to remain stagnant. So the next item is management fee. Now, some of you guys are doing this yourself, which is totally fine, and some of you like to vend it. For me, it just depends on where the property is, how much experience you have, and how much time you have. So the next item is size. So obviously, a single unit, I would suggest you try to do that yourself. I'm going to want you to try to learn the income and expense and cash flow things that you're going to need, especially if you're going to manage a property management later. But if you don't have the time, please, please, please do your due diligence and make sure that you've hired the right property manager so you don't have to keep going back because you're going to be unhappy with the high expenses or the occupancy is not going to be good or whatever other issues might come up. So the local or out of the area is a big deal. And again, this boils down to time. So for me, I like to manage my own money, which is why I like to have my own management company. Now, we, of course, have about 10,000 units right now. So, of course, we have a whole system of about 200 people to take care of this. But on one hand, I own the partnership that actually owns the property, but we also own the management company, which manages for the partnership. So there are two different entities. One's the property entity, one's the property management entity, and there's a contract between them that outlines all the things the property management company should do. Time and time again, I hear of horror stories where people have to fly from like LA to New York to go look at one unit because the resident trashed it, there's high expenses, and the property management's not doing a good job. So this is a big deal, and it can really, really add up on the expense side if you're doing it yourself and you haven't found a really good management company. The third thing is the fee structure. Now, I've seen on the bigger properties, this is as low as 2.5% to 3%, and I've seen it on some of the single families at around 12%, let's say, even a little bit higher in some locations. Now, the reason there's such a big gap is because think about it from a property management standpoint. How much time and money does it take for me to generate a financial statement, work with all the residents, pay all the bills, give you owner communication, send you reports, all that stuff? It's probably more than $100 a month. So many of you own single family houses, but from a property management standpoint, I don't know how much money you can actually make by charging $100 a month for those kinds of services. So be careful as you're negotiating these fee structures too low, because you might find a property manager that might take it, but might not give you great service. So there's always a balance there, because you also don't want to pay too much, but really what you want is the best property manager in the area, and pay them well. Trust me, you'll make that money back with high occupancy and managed expenses. So occupancy is obvious. If you have a vacancy or continued vacancy, then you're probably going to want to either take action by doing it yourself or getting another management company. Either one. Occupancy usually drives all decisions. Sometimes it's the expense side, but my experience has been mostly it's around occupancy. If you have a vacancy and you have no income, then all of a sudden it starts to put a lot of stress and anxiety. And of course, that's not why we buy investment real estate in the first place. Location. Now, this is a little bit different than local and out of state. So what I mean here is, where is it located in a geographic area? So you have some areas that have a little higher crime rate than others. You have some areas that are, say, next to a university, like I talked about before, where you're going to have a lot more turnover and you're going to need a lot more management. There's going to be a lot more velocity of stuff happening at a particular property versus, let's say, a senior community. So all of these things matter as you're trying to decide what the management fee is, and of course, how much work there is. Resident profile, I just talked about that. Same thing, student property, senior property, very, very different turnover, very, very different cadence to the way a property is run, and very, very different from a management fee standpoint. Obviously, something that's sleepy and doesn't require a lot of work, you can probably get away with a little bit less of a management fee, but something that's a lot of activity, maybe a renovation you got going on or whatever it is, it's probably going to be charged a little bit more. Now, the last three, accounting, reporting, and services, these seem fairly obvious, but the accounting is simply income and expense, kind of what we're talking about in this video. The goal, of course, for you is to have cash flow and some kind of return for your hard invested money, or maybe you're raising money from somebody else. But this accounting is very, very important. At a very minimum, you should require the accounting and financial statements are to you by the 10th of the following month. Non-negotiable here, because that is your report card for how you're doing and for how the property manager is doing. Reporting, this is a little bit different. This would be maybe a tenant moving in, a tenant moving out. This might be some of the traffic you have to the property, so you can see, is anybody showing up? Are they interested in the rent? Are our rents too high? Are they too low? Or it could be perhaps maybe on the marketing and how that's doing, or it could be just on the expenses. So this reporting typically in our company comes in every single Monday. On every Monday, I get a full report of all this information from every property every single Monday. Additional services would be, of course, organizing the tenants and any requests that they have, collecting their rents, managing any issues that they might have, either problems or opportunities even, paying all the bills, and even paying the actual mortgage. And then, of course, the only thing in a perfect world for you is to get a check each and every month with a fully occupied property. That is the goal of the management company. That is the goal of the management fee. If you find a good management company, please don't be cheap. Make sure that you're paying them well. It will be well worth your time. You don't have to pay above market. You just need to pay them well, because they will be worth their weight in gold. So advertising and marketing can be hit and miss depending on the size of your property, of course, but my philosophy is that you should continually always be marketing at all times, because you never know what's going to happen. You never know if a tenant is going to move out. You never know what the demand is going to be at a property, and you always want to have what I would consider to be a prospect list of people that might want to rent there. So generally, when we're looking at an advertising and marketing plan, we're looking, of course, at the location. The reason I bring that up again is you might have a property that's really buried behind a retail center, or it's maybe in an area that's hard to find or hard to locate. So that's where typically advertising and marketing costs are significantly higher, because you're just trying to get people to find you. Whereas on a drive-by, which I have down here, where there's all these cars flying by, you're going to find that these advertising and marketing costs are going to be a lot less. So size and turnover really do go together. Obviously, if you have a 50-unit building and you have 3 or 4 people moving out every single month, you're going to have a consistent turnover, which means that you're going to have continual vacancies, you're going to have continual need to rent those units, and you're going to have a continual need for maintenance ongoing to get those units rent ready for the new residents. All that requires traffic, advertising, and marketing. Signage is something that I highly recommend, and it can be as simple as just having your phone number or your email for the management, so that anybody can contact you at any time, whether those are the people that live there or they're the people that are looking to live there, or maybe they just have some questions. But in any case, signage at a property is a non-negotiable item for me. You always need a way for somebody to reach you at all times. Right. Resident referrals are a source that we use all the time. I would rather pay my residents a referral fee than actually pay an advertiser that I don't have a relationship with. And oftentimes, if they're referring their family or friends, then you actually create what's called resident retention, which means that if I have a friend there and we start to all do stuff together, it's probably going to have a lower probability that I'm actually going to move out later, which lowers my turnover, which lowers your turnover cost. The contact info we already discussed up at signage, and vacancy and future vacancy. I just wanted to touch on this because obviously in that 50-unit building where there's maybe 3 or 4 people moving in and out every month, you're going to always have people giving notice. You're going to always have a turnover at the property. So this is something that in the advertising and marketing world, you're going to always want an inflow of people. Now, you can do that a number of ways. You can do that just by having very basic social media. Websites are super cheap to get on. You can also hop on to somebody else's. You just want to always continually have some kind of flow of people contacting you at all times. Then it's as simple as running their background to see if they can qualify, afford it, and move in or not. And then we already talked about drive-by traffic, but I can't emphasize enough. If you buy a property on a main corner, let's say, then this advertising and marketing is going to be a lot less because you're just going to mostly rely on signage and contact information, and you're going to have a constant, steady flow of people. Repairs and maintenance is a huge category, but the biggest thing that I want to mention here is that it's an operational expense. And let me explain what that is. If somebody moves out of an apartment and you have to carpet clean the unit and paint the walls, that would actually fall in the repairs and maintenance category. In a minute, we're going to talk about capital expenses, which is very different. And that might be taking that carpet out and putting in a wood floor. That wood floor could last for years. And so therefore, that would be what's called a non-operational expense, which we're going to get into in a minute. The repairs and maintenance expenses can vary widely based on the condition and age of every property that we buy. So sometimes we buy properties that are dated, and just by renovating them, we're able to upgrade the entire place, charge a little bit more in rent, and of course, that's called a value add. So you're going to have higher repairs and maintenance costs for that particular property. The reason I put due diligence here is because a lot of these issues can be caught during due diligence. If you don't know what due diligence is, it's before you buy a property, you have a period of time to walk the interior and the exterior and try to figure out everything that's going on in that property. In our company, we walk every single unit. So you can imagine for 50 units, you can walk 50 units in one day. But what you find in each of those 50 units are things like appliances that are missing, or tenants that are missing, or flooring that needs to be replaced, or whatever it might be. These are all things that you're going to need to know before you buy the property, because otherwise you're going to have that expense hit in the R&M or repairs and maintenance category, and your cash flow is going to be affected. The next one is turnover. This seems obvious, but a property that has a lot of turnover, let's say I owned a property in Las Vegas. It was near the Strip. We had a lot of people that worked on the Strip, and we had almost 100% turnover. So you can imagine a 50-unit building. We had like 50 units turning over each and every year. Therefore, our expenses were higher each and every year because each time they move out, you got to go back and market it. You got to go back and paint it. You got to go back and do the cleaning and the maintenance and all the things that are required. So that can be really cumbersome and drive costs up. Whereas another property might be in a senior area where you might have 10 or 12 move-outs the entire year. So very different expense outlay and very different expense experience for that property. The exterior can fall in repairs and maintenance if, of course, nothing has been done for a while and you're continually doing outside repairs for parking lots and painting and roofing patching and things like that. That would all fall in this category. If you replace the roof, then of course that's going to fall into capital expense and more like a Capex, and which we're going to go into in a minute. The interiors, of course, are going to drive everything. So if you have a property that's been recently renovated, new appliances, new floors, all that kind of stuff, you're going to have very low repairs and maintenance costs. But of course, you buy something that's, say, been dated, or maybe has a lot of student turnover and it's been kind of beat up, then these are obviously going to be a little bit higher. So the capital projects are something that I want to discuss, and I've touched on a little bit. There's a lot of capital projects. One of the questions we always ask is to vend or not to vend. So think about that for a minute. If you have no staff, no payroll, then of course vending is a necessity for you. If you have a staff of, let's say, one maintenance person, and they're barely keeping up with the turnover of a unit, then they're not going to be able to do a lot of these capital projects. So the vend or not to vend is always a question. So do you vend paint? Do you vend interior turnover? All those kinds of things can be vended and can be done by a third party. These costs are going to be more money. In my experience with stuff we try not to vend are the HVACs or heating, ventilation, air conditioning, flooring, paint, and appliances. These are things that you can buy readily and have the maintenance people put in for you. And again, each property is going to determine how much R&M is going to be necessary based on the age and condition. Utilities is no different than anything except you got water, sewer, trash, gas, propane, electric, in, out. Electric in means inside of the units and out means outside, or let's say common area lighting. In many properties, you can find that the common areas are separately metered. So I have a property, for example, in Sun City that has hallways. It's a senior property. And of course, during the summer in Arizona, we're air conditioning the hallways. So our expenses for air conditioning or electric is a lot higher than a normal property. Let's say that's just a 2-story walk up and doesn't have any interior hallways. Some properties you're going to find that utilities are included. This is a good deal for the residents because you guys know utilities are under attack right now and the energy costs are going up. The last piece I want to talk about, the RUBS program, which is RUBS, which is Resident Utility Billing System. Basically what this does is it charges back these top basic utilities: water, sewer, trash, gas, propane. So how it works is you take away the common area from the bill because as a landlord, you don't want to charge the common area to your tenants. The allocation of water, sewer, trash, and gas and propane back to the tenant. And this could be anywhere from, say, $40 to $80 a month, but it's in addition to rent. So it's not included in rent. So you either have utilities included or utilities billed back to the tenant. Either way, a lot of times the utilities are the ways for the landlord to actually pass through some of these operating expenses back to the tenants because they are the ones that use these things and increase the net operating income, which we'll talk about a little bit more later. Insurance is a complicated thing, but my experience has been that many agents and even brokers don't always know what kind of coverages you have. And the only time, like anything, that you realize what kind of coverage do I have is when there's an actual claim. It's very important that you look at your coverages because I've found that sometimes I have coverages that I do not need and I actually need coverages that I do not have. Target number one is to make sure that you have replacement cost coverage because if you bought something, let's say it's built in the 70s or the 80s or even beyond, you're going to want today's replacement costs for that particular property. The second thing are around deductibles. So just like your car, if you have a $100 deductible, your premium is going to be higher than if you have a $500 deductible. Same thing with a property, because basically what you're doing, you're taking more risk off the insurance company by raising your deductible. For example, let's say we have a deductible on a big property of $25,000, let's say. If I have a kitchen fire in one unit that costs me $5,000, I'm going to pay that. I'm not going to turn it over to the insurance company because it's less than the deductible and therefore it's never a claim. In a way, it's self-insuring, which of course falls into that Capex category, which we're going to talk about in a minute. Insurance captives are something you should look into. Now, this is something that people are really doing right now because insurance costs are going crazy and people are trying to take a look. How can I self-insure a piece of the property but still take care of my big losses? So when it comes to losses, these are all real things that I want you to focus on. The code issues can vary widely from county to county and state to state. Now I'm talking about the ADA. I'm talking about sprinklers. If you have a property that doesn't have sprinklers and the county or the state now has sprinklers and you have a loss, you might be required to put them in as an example, which is exactly what happened to me once. So we had a property in Houston where we got hit by a hurricane. One of the things I didn't realize about a hurricane is that it swirls off the coast and then it has tornadoes coming out of it. And those tornadoes started to hit our property and we lost about 150 units. So I had rent loss, I had wind, I had flood, I had a fire that started. And then when we had to put it all back together, I had ADA and sprinkler issues and of course the upgraded code issues, all of which were challenged in the actual insurance policy itself. So these are real things that can happen, and you never think about them, believe it or not, until something happens. And in this particular case, this was one event. So wind and flood and fire are very different types of coverages, and you need to make sure that you have the right coverage for the right property in the right location. One of the things that we do is we make each tenant get their own individual renter's policy. Now that doesn't necessarily help you here too much, but if the tenant has individual issues, let's say water damage, mold, a fire, or something like that, it's possible that their policy can kick in and you won't even have to trigger your own individual policy, which will help, of course, at the renewal time, because if a lot of these claims never get reported and are handled by, let's say, the resident insurance policy, then you won't have to deal with these large increases from some of these insurance carriers. Property taxes are under attack right now, guys, because think of all the things. You got schools, you got fire, you got police, all that stuff is going on inside of here. And each county and state is a little bit different. The big thing here is to make sure that you check your values before and after you buy. So in many cases, let's say a property was $10 million and that's what the value was, and that's what the assessment was. When you buy it for, let's say, 15, all of a sudden, your property taxes can go way up as a result of that triggered sale. So the assessment calculation is something that you need to take a look at each and every time. We do this when we're underwriting a property and when we're looking to buy. We're always trying to figure out what the property tax is going to be after we purchase it, and the assessment calculations can be very, very different. I've found that sometimes they're different on one side of the road than the other. So be very diligent on checking these assessment calculations as it looks at what the underlying property tax is based on as it relates to the value itself. In many cases, you're going to find personal property tax is actually pulled out of this, which is good, and sometimes even charged at a different rate. And then, of course, in many cases, you're going to have these special improvement districts, which are just a way for the city or state to do additional work and charge it to all the homeowners in the area. My experience is you should appeal your property taxes each and every year, and you should find a company where you can actually pay them a fee, but only based on the amount that they save you, not necessarily a flat fee if they win or lose. So the last piece is the capital expense or Capex. Now, these are just some of the things that you need to be looking at during due diligence, and maybe you already own something, you have all these things. These are what we call non-operating expenses. So roofs, parking lots, paint of the exterior, drainage problems, electrical problems. These are buildings or big things, not necessarily repairing things inside of the units. Plumbing, environmental. We've had mold. We've had radon. We've had all kinds of things here. Interiors, of course. If you're going in and do full renovations, you're putting in new floors, new appliances, those actually can be capitalized. And then, of course, the amenities like fitness centers or big clubhouses or pools or whatever it might be, fencing and gates, and of course, code issues. We can't tell you how many times we found properties. Many of the owners don't even know that they have code issues, mostly around fire or even handicap accessibility or whatever it might be. So these are all things that would not be considered operational expenses. However, they're real and they're real expenses, and they can drain your cash flow if you don't have a handle on these. So be very, very diligent. Make sure that you know exactly what you're going to be doing each and every year. So just to summarize, in the first video, we talked about income. In this video, we talked about the expenses, which is payroll, management fees, advertising and marketing, repairs and maintenance, utilities, insurance, and property tax. So those expenses after income is what we call the net operating income. This is the number that the lender uses to calculate their debt. After that is Capex, or a non-operating expense. And so the lender is going to take a look at the condition of the property. The lender is going to attach a Capex number to your property, but it's going to be a non-operational expense. These expenses can also be capitalized and used for tax purposes and can actually be a benefit to you as an owner. So next we're going to look at video 3. And of course, we talk about income and expenses in video 1 and 2. But in video 3, we're going to go into debt and actually how it relates to cash flow. So all of these three work in coordination with each other, and this is exactly how professional investors look at properties, and this is exactly how lenders look at properties. So you're going to want to look at that third video as well, and the three of these in a series. If you're investing or you're acquiring, you're going to want to check out all three of these videos because they're going to help you maximize your income and cash flow for each and one of your future deals.